and that is, of course, the WEEL ETF. And as far as I can tell, you guys are the first ETF on a mass scale that is running the WEEL strategy. I think that, I discussed this with you and we'll talk about it with the audience, but there's a lot of advantages to running the strategy with large quantities of capital, from just the different types of ways that you can run it, the different names that you can run it on that just, maybe the average retail investor couldn't. And it's also, this is obviously one of those income focused ETFs where you're not necessarily looking for, a ton of return, but it is nice to see that it's, moving decently back to the upside after that, a Black Day market drop that was happened back on the 7th. It's popped back really nicely from 1950 back over that 20 level. And as long as I think this thing's sitting above that 20 level, you're probably in pretty good hands just looking for the income to be coming in. So let me turn the mic over to you real quick, Eric, that you could give perhaps some background on yourself because you do have a pretty strong background in finance, as well as Rob, and then we'll dive into the wheel itself.
Great. Thanks for having me. Yeah, we're excited about this. You hit the nail on the head. There's really no one else out there that's created a publicly traded available, mutual fund or ETF. And I've seen them all, and I'm 99.9% sure no one else is doing this. There's a ton of covered call strategies. The wheel is, I think most of your listeners probably know, kind of combines the elements of a cash secured put, with then if we get assigned, we write a call and it gets called away, we're back to cash. And it's a continual process of recycling premium around strike. And we don't need the markets to go up to make money, but I'll give you more on that later. Background about me. My whole career has been, I'm a retail financial advisor. I spent most of my time with Wells Fargo. I left about 5 years ago, started my own registered investment advisory, Peerless Wealth. And then Peerless ETFs is our kind of spinoff from that focuses on the ETF. And so most of my career has been spent counseling clients on, preserving a retirement account or building a retirement account. And quite honestly, up until maybe 5 years ago, I was very kind of by the book with asset allocation. It would look like a pension fund. If it would be, you'd have the S&P index for your large cap portfolio. You'd have, a REIT index, a small index, maybe some bonds if they're retired. But when interest rates got really low about 5 years ago, I was looking at my bond allocation. I'm like, this money's dead. It's paying 2%. If rates go up, it's going to get whacked. So I started looking at a lot of these alternative strategies, including most of them had an options hedging methodology to them. And I started running, what we call the wheel with my own money at first, and it was working really well. And we're renewing these positions weekly, so we're doing very short term, and there's reasons for that. We think it protects better in a down market, but it's a lot of work. I can't go through each client. I got over 100 clients. I can't go through every Monday morning and do 15 trades in over 100 accounts. It's just there's not enough time in the day. So I was talking to Rob, and I'm like, yeah, we need to. This was 2 years ago. And I'm like, we need to, scale this. Let's create a mutual fund or an ETF, and one, so we can, put a position in all of our client accounts because we really believe in the strategy. And second, no one's doing this. It's working. Let's give other people the open door to invest in it too, and see if we can grow this thing. So the ticker's new. It's not even 3 months old. But the strategy, we've been running it in a hedge fund for over 2.5 years. It's beat, its category average by a decent amount. We're considered the derivative income category. I'll get more into the strategy. Rob, you want to introduce yourself too and give a little background?
Yeah, thanks. Sorry about that, man. I didn't have mic access, I guess. Shows you how new we are to this. I appreciate that. As Eric stated, we've been working together for years now. This just made sense, and we were surprised to see that nobody had packaged this. I mean, I've been a retail trader for probably a decade and a half, turbine engineer by trade, so just made sense with meeting Eric and really aligning on strategy and wanting to press this forward. So I don't know how deep you want to dive into details just yet, but
Jordan,
I follow.
You want me to give you a verbal kind of summary of how we're running the portfolio?
Yeah,
Yeah, that yeah.
absolutely. I definitely wanted to hear the background of
Okay.
that for sure.
All right.
Cool.
So I'm going to say this is going to be a conservative strategy based on what I believe your listeners to be into. So this is, you're probably going to think this is kind of chicken but I'm all about protecting capital. And I have clients that are retired. I have foundations and charities, and we don't want to take big hits. But what really this is designed to do, we're not guessing where the ball's going to go. What we're doing is we're positioning a player in case we have flat or range bound markets for the next few years. I'm not predicting that, but we have this statistic on our website, but I'll verbalize it. Since 1925, so almost 100 years, the S&P 500 calendar year performance, 49% of the time, it's over 15% for the year. Those are your bull markets. That's why we own stocks long. And me personally, I don't trade in and out of them. I just kind of more of the Buffett style, buy and hold, good quality stuff. On the other side, about 20% of the time, the S&P loses more than 8%. Those are your bear markets. That's the time when, for my retirees, they own some bonds. If you're young, you just sit through it, maybe buy more if you can. Now that leaves about 32 to 33% of the time, about a third, where calendar years finished between -8 and +15. That's where the WEEL strategy, the way we're running it, we're super confident it'll be the best part of your portfolio, because what we do is we start up at the top of the wheel with cash secured puts. And when we say cash secured, we use T-bills. And what we do is we write a weekly, sometimes we go longer, but normally it's weekly, a weekly out of the money put on a sector ETF. Okay, so why do we use sector ETFs? Well, we don't use individual stocks, and I'll tell you why. There's some exciting premiums. They're really tempting. But when you're doing cash secured puts and covered calls, and let's say you were just running a long only account and you had 10 blue chip stocks, they were diversified, and you weren't doing options, just long only. You might have, in any given year, you might have your bottom one lose 50%, your worst one. But then you might have your top one make 60 or 70% and make it up. With this strategy, we are capped on the upside, whether it's a cash secured put or covered calls. We're never going to have that 70%er. We're just not. So, but we're fully exposed on the downside. We have a buffer because we're writing them out of the money, but we will at times get assigned the shares, and we are fully exposed to the downside. So if you're fully exposed to something that could lose 50% and you don't have anything in the account that's going to make over your cap, it's certainly not going to make 70%, then when you run these strategies, you have to be hypersensitive about downside protection because you don't have something on the other side that can make up for it. So that's why we don't do individual stocks, because we all know, a diversified ETF is, it'll drop, but it's not going to go away, and it's not going to lose a ton because it's diversified. So the way to be hypersensitive about the downside is be super diversified. Don't just do this on a few names, because if one doesn't work out, you just can't come back from it. You have to, because every now and then you're going to get assigned shares. So now, why don't we just do it on SPY, right? The index, we could, but there's not enough premium in SPY. It's too diversified. You got consumer staples in there, REITs, utilities, and those sectors have very little option premium. So what we do is basically pull apart SPY, the different sectors of it, into financials. Like we'll use KRE. We do IWM to hit small caps. We do the Qs, and then we'll do we'll do the XLI, the industrials. We'll do the home builders. All these sector ETFs that if you just owned them all long, it would resemble like a diversified equity portfolio. We write options on ARC. But we get a lot more juice, a lot more premium out of doing it on each sector than we would just on doing it on SPY. But as a portfolio, it's not too far off from SPY. because obviously there's more risk with a sector than there is with the S&P, right? So what we do is we start with on a Monday morning. Let's pick, we can pick like the XL, the OIH, which is the Oil Services Index. Let's say it's $300 a share. We will write an out of the money put, cash secured or T-bill secured, and we'll pick a price. Maybe we'll do the 285. Okay, so we have a 15-point cushion for the week. It can drop, just not more than 15 points. And as long as it doesn't hit 285 or lower, we keep our premium. Now that premium, we might get 80 cents for it, which sounds like nothing, but we're doing them weekly. So if you multiply 80 cents over 50 weeks, I take 2 weeks out because of holidays and that sort of thing. That is what we call an APY, annual percentage yield. I don't know, it's the best way to describe it. We have to put up 28,500 of like 14%. So we usually shoot for around 15%, 15 to 20% of what I call the APY when we write these options. If OIH always stayed above 285, we would make, in my example, 14% for a 1-year period. Plus, we're making nearly 5% on our T-bills and money market. So we're up close to 20. We can drop 14 points. We don't lose a dime. Now, occasionally, it will get assigned, meaning it'll breach 285. Let's say it finishes the week at 282. We got to buy it at 285. Monday morning, we're down $3. Then what we do is we write a call. So we own it. We don't sell it. We write a call, and we typically put the strike price pretty close to where we got it assigned, like that 285. Sometimes we go a little higher if we're feeling, a little greedy that day. But normally we put it kind of right back to where we got it assigned, and we might collect another $1 or $2 premium. So we collect income from our put, income from our call, income from our T-bills. If we get assigned the name and it pays a dividend, we collect dividends on that. And then eventually it'll hit 285. It gets called away. We're back at cash, and we start that wheel over. And then we're doing that for about a dozen different sector ETFs. And we're running each one of those, its own little wheel inside the portfolio. So in a surging bull market, we will not keep up because we're not going to make over probably 20 to 25% in most calendar years. Last year in the hedge fund, I think it did 22, 23%. But the year previous, when the market dropped 20%, we were only down about 10 because we're protected on that first little bit of drop. And we reset that every week. So we don't need markets to go up. If they're just bouncing around, and we're sitting here 3 years from now and the S&P is still in the 5,000s, we're going to most likely have a double-digit rate of return. The $20 a share, this is important. It pains me to say this, but do not expect that to go up over the long term. You will make your return on this through a quarterly dividend payment. That's all premium. This is not a capital gain strategy. This is a dividend strategy. But it doesn't mean you won't be making double-digit returns. It's just going to be in the form of a dividend, and you can reinvest. So that's it in a nutshell.
Beautiful rundown there from the top, Eric. I know that this panel has some thoughts and questions. Paper Games, you want to jump in first?
Yeah, sure. I'm not sure how familiar, I guess, the audience is necessarily with this, but it sounds like, so I am, but it sounds like you guys have been doing this for a really long time. I absolutely love everything that you've said so far. I mean, we've seen the put selling ETFs kind of like explode recently, but to me, and Wolf knows and Evan knows, my thing has always been, look, it's completely one-sided. If you have these black swan events, it's not going to be fun. And a lot of them on individual underlying. So for me, everything you're saying is exactly how I personally run a wheel. I have yet to come across a company that's designed an ETF until Wolf sent me your information. He just asked, hey, what do you think about this? And I was like, yes, like single word, one, yes. I've really yet to find a company out there that's done this like it as it makes sense. Because you're right, you don't have the single stock risk. ETFs are the way to go. So that brings me to my question: is when you mentioned you're doing kind of like sell puts then sell calls. My first question is, one, are you ever net short calls and puts at the same time, or are you strictly wheeling one after another, or do you have like a ladder wheel on where some you have short
Okay.
calls and you have short puts on? And then the second is, when you're doing the other ETFs, which I also do, how do you rank them? Are you ranking them by IV rank? Like, this has a high IV rank right now, so we should go to OIH, or et cetera and so forth.
Good questions. As far as like laddering strikes and time, we do a little bit of that. We usually just go Monday through Friday, but the Qs and the IWMs that have now trade every day, or maybe the IWMs are every other day, we will structure those Wednesday to Wednesday, just to give us some like time diversification. And occasionally we'll have different strikes, but it's normally when, we just opened this fund 2 to 3 months ago. And so as we see inflows, sometimes the money comes in, on a Wednesday, and we don't want to wait, or the price is different than when we did the trade on a Monday. So we have a different strike because the money came in different times. But so mostly it's Monday to Monday, but we try to stagger it a little bit. We never have like we could have, like right now, there's a few positions that we have cash secured puts on, but then we also own the underlying because they got assigned to us maybe a week or two ago, but then some new money came in, and so we just did puts. So we're a little bit of both, but normally that's not the case. How we pick the ETFs, what we are not doing is making any predictions or guesses as to like sector rotation, like banks are hot, let's do more KRE, or industrials are where to be at. Like, pretty much what I'm doing is I'm breaking down the S&P 500. And if there's a 11% exposure to industrials in the S&P, you're going to get about 11% of XLI as exposure. Now, it's not exactly to that because we leave out staples, REITs, and utilities. And then we do about 15% on small caps, IWM, which is not part of the S&P. And we also have a couple. We use ARC and we use KWeb for a little bit of international exposure. But, on a rough basis, it's kind of just like the S&P broken out into sectors. Does that help?
Paper, any other thoughts?
Yeah, I want to.
Yeah, so that helps. But so you're not doing any like, okay, this has a higher volatility.
Okay, let me answer that. Let me answer that question.
To prioritize, right?
Yeah, what we tend to do is start with what I call my APY of maybe around 15%, knowing that we're getting close to 5% on our cash. Higher vol environments, and we've been in that for the last week or two, we can get closer to 20%. Lower vol environments, like a month or two ago, we were more like 10 or 12%. So we usually start with a target rate of return, and then that determines our buffer or our cushion. So on OIH, like, what premium do we need to make somewhere around 15% a year? Well, we need 80 cents. Okay, what's that? It's the 285. Okay. Yes, we could get more premium by doing the 290, but now we increase the risk of the fund because now it only has to drop 10 points. And we want this to be a lower volatility solution to getting S&P like returns. And so we want to be protected on the first leg of the downturn. Otherwise, you're just getting closer and closer to just kind of mirroring the S&P, and you don't have any of that flat market protection or downside protection. So that usually means the deltas are around 20, which means that, statistically, if I understand delta correctly, we got about a 20% chance of assignment every week. So 4 out of 5 weeks, statistically, we'll just rinse and repeat and write puts. And then when they get assigned, here's why I really like the wheel. We wait till let's say it gets assigned and it keeps going down, right? That's everybody's worst nightmare in wheel strategies, especially if you're doing individual stocks, which is why we don't. So let's say it keeps going down and we keep writing calls. Well, eventually, if we're trying to get back to our price we got it assigned, we're not going to get any call income anymore. Other covered call funds, in order to keep distributing income, will reduce their strike price down so that they can get more call income. But then, and this week was a perfect example, the best days in the market typically happen after the worst times. So you don't want to get called away early. That's the problem with a lot of covered call strategies, is you get all the downside and then you get called away in the upside. You don't get the rebound. And we will not write calls. In fact, Rob, I mean, maybe you can just tell the last week or two, we waited a little bit till today to write some calls.
Yep. Yeah, and you had hit on this. I just want to stress it again. One advantage that we have is, lead market maker is going to gather assets as they come in and do a block create. So let's say a block create comes in, we're semi in the hole on a position, right? Now we get a chance to average down by selling more puts. So that's a huge advantage right now while we're small. And maybe sell some calls at an average down, but net it's still going to work out in our favor.
And we would rather forego a little bit of call income in a bear market or correction than to miss that big rebound on the upside. Yeah. So we got to get back to even, because I don't want to be one of these covered call funds that has all the downside and gets called away on the upside. The profile is going to be more conservative than a covered call fund because we get that cushion, that cash secured put side where we're out of the money. We're going to miss the first chunk of that drop. I mean, in the hedge fund, I think it was, I don't know, Rob, was it April where like the S&P dropped, a little bit every week, and it was down like, I don't know, 3%, and we were actually up because nothing hit. Nothing.
Correct. Yeah.
In most downturns, including I know we have a short track record on the ETF, but including the recent one, I think the S&P was it was down about 10% from peak to trough, the trough being like that Monday open. We were down 5%. So we tend to go down roughly 50% of what stocks do, but it depends on the speed of the downturn. But then we're trying to get most of the upside. We're trying to be a solution to where, if we get a shit market and it's just bouncing around the next few years, you're still going to get double-digit rates of return.
Yeah. Our long-term beta is about 0.63.
Yep.
So I appreciate that, guys. So the other question was, so I hear. I mean, it's all, music to my ears for sure as a wheel trader. But so one outstanding question: in that scenario, what I heard you say is, okay, we've been selling cash secured puts, we've been put the underlying equity, now, and we've been put the underlying equity. Now it starts to go up. We're not gonna sell upside calls until we feel it makes sense, or until we basically revert to the mean. But in that instance, am I hearing it right where you're basically naked long equity, so you don't have any short puts at that time and you still don't have any short calls, is what it sounds like? So can you confirm that? And then the second piece is there still a situation where you're both short calls and short puts at the same time on an underlying? I think I heard it, but
yeah,
I wasn't sure.
Yeah, a couple situations to explain to address those questions directly. And I'll take the latter first. And it's applicable to both, really. Eric kind of touched on it initially, but we really like to structure the portfolio, like allocate it on a percentage basis. So we're going to look at our AUM and break it down into those piece part components. and we're going to allocate that sector to a specific amount of dollars, right? If new dollars come in and we're only long that sector, we now get to add to that position on a percentage basis by selling more puts, and therefore possibly getting to lower our basis if we get assigned those shares, right? So that's a situation. That's a first situation where we may be long the position, but get to sell more puts because on a percentage basis, we still want to keep our allocation within a balanced, target positioning.
So it's only because new money's coming in. If there weren't new money coming in, we wouldn't
Yeah.
have.
Yeah,
if I
that makes
was
sense.
a retail trader with 100 grand and I had to allocate a portfolio, I don't have that luxury, right? I've got to stick
Sure.
right where I'm at. But we get the opportunity to average down if flows come in.
So
And
then so I guess do you do it by if it's based on AUM, and then you look at the market dynamics and say, okay, it's better to not do a buy right here, but maybe sell some cash secured puts to enter, or what have you, and then if you already have position, and then you do get that increase in AUM, and the perspective says, okay, we should increase our allocation here. Will you do it? You'll just do that by selling cash secured puts, even if you have a buy right on at that point in time. Is that what you're saying?
Correct.
Okay,
Correct.
beautiful.
Yeah.
Got it.
Correct.
Totally understood.
So we're going to
time,
allocate. It's all.
yeah,
Go
the
ahead,
only
Eric.
time we buy is if we get assigned at a lower price. We're never buying at the top. We never just buy in. We're always writing a cash secured put to do
Got it.
Yeah. Now, to answer your other situation on if we could be potentially short puts and short calls on the same product, is that the second question?
Right. So I'm
Okay.
just assuming, let's say
So
you're staggering your time series, right? You're staggering your series. Let's say one series your short puts, and that lot gets assigned, and then you open up a new lot, sell some more puts, and eventually you've sold calls on that first initial lot. Is that how you're managing, or is all like, this is my net position?
you're absolutely correct, and we will never be.
Or
We
more
will
the latter.
never be. We'll never the latter.
Okay.
So we will always have two things to really stress here. We'll never be naked short calls. So we'll always have a long position. If that long position, if there's a delta that appropriately targets our return for that week, maybe 2 weeks, whatever it is, we'll cover that position. And then if there's still a percentage AUM to allocate to that sector, we'll then rewrite puts on the remaining percentage. And in that situation, we could be short puts and short calls on the same, but different notional, right?
I'll give you an example. The Qs, they were the hardest to correct, and we got those assigned. What was it, Rob? Like 480 something?
Yeah, we got a tranche at 484 and a tranche at slightly higher than that, like 490.
Yeah, and then they went down quite a bit.
Yeah, and we're also short puts in a position on that in the
because new
Qs
money
as
came
well
in.
right
But
now.
they went down all the way to like 435, and when they were at 435, in a normal situation where maybe it didn't drop that much, we would just go ahead and write a call, get more income, get it back to our strike and back to where we bought it. But they were down so much that if we were to put a strike price back at 488, we just weren't getting hardly anything for the call. So Rob and I were like, you know what, let's just wait a little bit. And it rebounded. And just today, we wrote calls and got a lot more on it. So there's some active management going on. A lot of it's process and rinse and repeat, but then typically when we're writing the call side, there's some active management going on. And I will say one thing too, because Rob mentioned a typical retail account of 100 grand, just as an example. In my example on OIH, you would need, just on that one trade, that one cash secured put, you would need, for the 285, because one contract is 100 shares, you would need 28,500 in your brokerage account, cash or T-bills, to secure that. That's on one position. So now we want to diversify, right? We need Qs. That's another 46 grand. you go down the list, and before you know it, you need 200 or 300 grand to, in my opinion, be diversified in a wheel program. And that's a barrier for a lot of people. And it's a barrier for my clients. You know, my typical client, I might only put 10 or 15% in the wheel. It's one part of the portfolio. So you would need almost $1 million. Sorry if I cut off. You would need almost two or 300 grand. Well, with the ETF, obviously you can get in for $20 a share. So what happens though is a lot of people, when they try to do the wheel themselves, because they don't have 200 or 300 grand, they're forced to write puts on low priced securities, which can get riskier and riskier, especially if they're individual names and not ETFs. And they're forced to own a shorter list.
Yep. Or lever.
Yeah.
Yeah.
Good points back and forth there, guys. I got a quick question from the audience before I go to others that are on stage. Somebody asked what the last quarter dividend payout was, and then they talked about cash that you have on hand. Is that just being used to secure puts? So there's no interest payment on those, or are you getting also 5% on that as well?
We're getting the cash. We are getting, I think, 5.1 on the money market fund, and then we're getting, in the 4s on the T-bills. We're just talking about this, Rob and I, and we're actually just probably going to use more of just the money market fund because it's a higher yield in this environment. I mean, it could normalize, and we don't want interest rate risk. We don't want to buy like 10-year treasuries and have that part of the portfolio bouncing around with the bond market. So we have to stay very short term, but we are getting interest on that up close to 5%. The dividend, I'm not allowed to say what it's going to be, but here's what I can say. We're going to pay it quarterly. Why not monthly? I know everybody likes monthly better. There's administrative costs and there's lost return by paying it monthly because you have to have cash readily available once a month, which doesn't sound like a big deal, but there might only be 18 or 19 trading days in a month. And maybe we got to not use that cash to secure puts for the day of the pay, the day after it, and the day before it. So we could be out, we could be out 3 out of 18 days. And that's premium that we're missing out on. So we'd rather pay it quarterly. That we're confident that's going to create a higher yield. The first quarterly dividend will probably be announced in mid-September. Now, we started the fund in mid-May. We didn't pay a June 30th one because it would have been prorated and it would have understated what we would pay because it was only for half the quarter. So we just, the SEC lets you skip the first quarter. So the first dividend, it's going to be quarterly. The first one's going to be mid-September announcement, probably pay before the end of September. We have to pay per SEC mutual fund ETF guidelines, 1940 Act. We have to pay all the income out and all the capital gains out by the end of the year. That's our entire return. We don't make capital gain. It's all premium income from options, interest income from the T-bills. I just told you what our target is, right? 15, 20%. So you can do the math on the dividend. We may pay a little less than what we could, but make it up at the end of the year. So in most quarters, you may see it slowly get above $20 a share, maybe 21, and then it pays a dividend, goes back down to 20. But yeah, that's about all I can say about the dividend. It won't be like yield max numbers. It's not going to be that. But this is an income fund. And so it'll be high, at least relative to a typical stock or bond fund.
Awesome. Thank you. All right, Evan, did you have any thoughts or questions here?
Yeah, no, I definitely appreciate them for coming on the spaces and, just educating us. And it's really interesting here. I won't lie, you hear Paper Gains, who's on the totally other end of the spectrum. This guy knows exactly what he's talking about. And me, I'm on the fully end. I have not done my research into the wheel strategy. I'm such on the other end of it. So like when I am doing research into this, what do you think are kind of like just with the strategy itself, some of the risks that maybe I should be aware with, maybe some of the ways that you guys mitigate that, and then just in general, as I am doing my research, I'm on the website right now. Where are some good areas specifically for me to be looking on the website to get more research known?
Well, there's a Q&A section, or a FAQ, I guess, FAQ on the top right of the banner. And, you know, there's a lot of it here. How much return can I expect from the WEEL? When does WEEL pay dividends? Where does it fit in a client portfolio? How does it reduce volatility? How is it different than a covered call fund? There's a lot of stuff on there. I would say the biggest risks are probably missing the upside in a strong bull market. Because we're not going to make, especially if the bull is happening very short and quick, like in 2 or 3 months, the S&P goes up 15%, right? We're just going to plunk along at, like 20% annualized, give or take. We're not going to get the big spike up because we're getting called away, or we're not getting a sign. We're just getting our premium. So it's not a substitute for, a long only strategy. It's if we get a bear market and we get assigned everything, I can't make promises, but it's highly likely you would drop less than the S&P 500 because of the fact that you have that initial protection or buffer before you get assigned shares. And we're probably collecting some call income. So it's just got that profile to it, that kind of risk return profile. So it's going to be like, maybe retirees that want income, but have a little higher risk appetite than bonds, but don't want to sell, their capital out of the S&P and just want the income. It can work really good for. But yeah, we're putting it to perform in a flat to range bound market. That's what it's there for.
Perfect. I appreciate that, and I know it'll come from handy for a bunch of people who are also digging into this ETF as well.
And I'll tell you the other thing. You say maybe you're on the other side of it. I kind of joke with Rob, like we're selling to the speculators. We're selling the calls and we're selling the puts to people that are speculating that something's going to skyrocket or crash. We're just taking the other side of the trade. And it's an income side, it's more conservative side.
Got another question, which was, can you just elaborate on, the risks that apply to running a strategy like this, and what could go wrong with type of situations, how you would address those things like that?
I think the biggest risk is maybe, if let's say that, we get assigned 3 sectors. We get assigned, energy, XLE, OIH, and I'll pick another one, the home builders, ITB. And those get assigned and they just keep dropping really, really hard. And the rest of the market's okay. So maybe the S&P index is still doing pretty well. We may lag a little bit, but we've back tested this for over 10 years through simulators, some software that Rob actually piloted that. And, even in some of those environments, it holds up really well, better than the market. Rob, do you have anything to add?
We actually had this happen earlier this year, right? I mean, we had that quick drop in the Qs, IWM kind of hanging there a little bit. But oddly enough, retail, kind of energy, communications, materials, all kind of hung in there. We got some stuff assigned really, really quickly, but the rest of the portfolio hung in there. We continued doing our thing, just collect that premium. And just to add on something that
the other thing that happened, and maybe this is saying the same thing, but as most of the listeners know, at least the first half of this year, the bull market was largely driven by the Magnificent Seven tech stocks. And I think somewhere around June 30th, I'm going to guess, and let's say the S&P was up 16%. But I remember seeing a statistic that if you took the Mag 7 out, the S&P would have only been up like 3%. So it was a huge thing. And we didn't participate in that, Mag 7 surge because, yeah, we're writing puts on them. We use the SMH, the semiconductor, we use the Qs. We're getting puts, but we're not going to, we might be getting 20% annualized slowly over the year. We're not getting a 20%, skyrocket in 2 months, right? So, you could have sectors that kind of, but we're still up in the hedge fund, which we run the same way. It's still up like 10 or 11% for the year. So, we'll do fine. But if you have a runaway sector, one way or the other, you could have some short-term impact. But now we're seeing, the Qs and the semis that corrected, quite a bit, and we're not lagging as much.
I just want to add too, I mean, to kind of reiterate what you said earlier, Eric. I mean, we're advisors too, but this is how we trade. We're super passionate about this, which is why we kind of clicked together and came together to make the product in the first place. As you can tell, we're super passionate about it, but we're also advisors, and we understand that this deserves this deserves a sleeve in a portfolio, but you gotta have super long-term exposure to equities, right? Especially if you're younger in age, and this certainly isn't a replacement for that, but we think it has its spot for sure.
Yeah, I probably have 25% of my entire portfolio in the wheel, and I'm as passionate as anybody about it, but I'm aware of the risks of underperforming in a bull market, and so I believe in owning long-term equities for the long haul. So I still overweight, just long only, but this is my hedge against if we have shit markets for the next few years. I'm not. This isn't a bear market solution. Like it won't go up when stocks go down, but if stocks bounce around and don't do anything, this will do really well relatively to what else you probably could have been in.
Sniper, did you have a question there?
Yeah. Actually, I have two questions, but I want to start things off and just say congratulations on launching this vehicle. It definitely seems like something that's very useful for traders, considering the difficulty of running the wheel strategy, and this makes it significantly more accessible. My question for you, the first thing I'm going to ask is, personally was not familiar with the wheel strategy, and I found out and really kind of understood what exactly it is by looking online and looking at a graph that would kind of show a cause and effect. If, like, for instance, if the stock goes up, this is what the reaction is, or if the stock goes down. I was wondering, do you guys have anything published that would be kind of like a chart or something that would explain towards investors or potential investors what exactly you guys will do in certain scenarios?
I don't think we do. The only thing I can picture, Rob, is that graphic that I talked about at the beginning where,
So I'd like to point everybody back to our website. We certainly have materials we can provide, but there's a really great explainer video and strategy overview that Jessica Inscutt actually narrated for us. We connected with her and wanted to partner with her because she was passionate about this and has done some presentations on it and knows its effectiveness. And she does a really great job of explaining the basics. Hey, I'm interested in this product. I sell out of the money puts. It drops. It can only drop this much. X kind of walks you through the process. There's some really great graphics in that video itself.
Yes.
And there's tons of stuff online. I know Eric said we certainly don't claim to have invented this strategy, right? It's a known strategy. There are tons of permutations and variations, but when I hear people talk about it, and this, Eric and I came together, we're like, look, we hear people talk about this all the time, but they're too aggressive, they lever, they, you know, like you said earlier, they're in products that are too big for their portfolio size. We wanted longevity. We wanted a product that would, you know, you could really own for that specific sleeve of income in a range bound market. And we've done tons of, as he said, back testing. We forward tested it for several years. And so, yeah, I mean, I would definitely check out that video. There's tons of stuff online. Something that immediately comes to mind because we're good friends is Tasty Trade. I'm sure a lot of people follow Tasty Trade in here that, you know, can learn option strategies from them. 8 hours of free content every day. It's a phenomenal resource. So there's certainly education out there, and as I said, we're super passionate about this. It's how we trade. Ask us questions. Send us an email. You know,
And,
send us a direct message. Whatever. I mean,
and a lot of these videos, when they do the wheel, they're picking like 3 or 4 stocks, like Tesla and Coinbase, and I'm just cautioning everybody around that because those names, the premiums are rich, but the companies, they're rich for a reason because they're very volatile. And again, you don't get any upside except for the premium, and you have all the downside. So it doesn't matter if you get a high premium if the share price drops 40% in 3 months. Like it just doesn't. So just be careful with individual stocks. I'm not saying you can't, don't do them. Just you know, do at least 6 or 8 of them and make sure they're in different industries. Don't do 6 or 8 tech stocks. It's just dumb.
That was an awesome answer. I'm definitely going to look to check that video out. I have one last question for you. In the event of a sell-off, and again, I understand before I ask this that nothing in the stock market is guaranteed in any way, shape, or form. But in the event of a sell-off, I understand that the objective is to keep the share prices close to $20. Let's not call this a black swan event, but just some shares being sold that causes the stock price to drop. Would you guys still plan or attempt to pay a dividend in the event of a sell-off?
Really good question. We've talked about this a lot, and what the SEC allows, again, we have to pay the entire income out before December 31st. But if we can bank it, so to speak, we can pay maybe a little less in the first 2 or 3 quarters of the year. And we plan on doing that, not paying it all out because of what you just asked. If we get a bear market, when we get a bear market, then depending on how long that is, you know, we may have 3 months, 6 months, or we just decide either not to write calls or to, you know, we're not going to get as much income. So the plan would be that you know, let's say that happens in September, we're still going to have some banked dividend from earlier in the year that we can pay out. If we don't, or if it goes on for a long time, the dividend could definitely drop. We're trying, you know, everything we can do to not do that, but we don't want to pay the dividend by selling calls with too low of a strike price and then getting called away. We're not going to pay a dividend at the expense of missing out on rebounds.
Thank you again. That was another great answer to that question. I appreciate it.
Yeah, I'm going to jump in real quick. I did pull the link to that video that's on YouTube and posted it up in the nest above and replied to this space as the comments. So that video is up in the nest if anybody's interested. It is. I actually was just halfway watching it while still listening on here, so that is up there up top for everyone.
Oh, and let me add something. We will not participate in what's known as return of capital. So we're not going to pay a dividend to keep the dividend up and have that come from selling shares. That's just dumb.
Knots. Yeah, all good. Knots, do you have any questions here? No worries if not.
I'll add one more thing to that since it's kind of light on questions right now. As we stated, Eric and I have been studying a lot of this and what different things we can do. And part of the portfolio, a very small percentage, is volatility position.
Oh yeah, the VIX.
So, I mean, we hope that that continues to just help dampen, get that beta down, or just what you're saying. If there's some type of event, what can we do to hang in there a little bit better? And that's the type of things we're looking at.
Yeah, so we're I don't know if it's 4% or 5%, right in there. We're writing puts on the VIX. We're using the ETN VIX, and that actually might get assigned tomorrow. We'll see, because the VIX has dropped a lot. I think we have a strike at like 47 or 49. But if we get that, now we own volatility, and if we get a really bad market early next week, that will go up in share price. So thank you, Rob, for pointing that out.
Can I ask a question? So you're talking about futures options, or you said which?
It's an ETF.
VXX.
It's called an ETN, an exchange traded note.
VXX.
Yes, sir.
Oh, volatility.
Well, wait, I think it's, what is it? VXX or VIX?
VXX.
VXX is volatility.
Yeah, okay.
Of volatility.
Yeah. We wanted to use the paper gains. We wanted to use that. We wanted to use the index correctly, but there's a lot of, when you get into SEC regulations, there's a lot of really strange things that come up around where the
that's weird. So when I used to run like very active wheels, I would use like a ratio spread on VIX futures options as my quote unquote like black swan hedge. I'm sure you guys know what that is. Maybe the others don't, and then kind of peel it apart if I got the spike right and turn it into a credit spread. But so in that VXX situation, so you sold puts on that, you get assigned. Now when you start selling calls, since it's a bit actively managed, would you get aggressive in selling calls, believing that it would possibly come back down to 20 or lower? Like, what is that something?
Yeah, we're gonna have a target on what that return is, right?
Okay, well, we're gonna want to get back to where we got it assigned at least.
Well, I mean, it probably won't ever go back up there, right? Like it's not designed to do that.
Well, but this week we might get it assigned at 48, right? I think we have.
Oh, okay, got it.
Right, and then Monday
you
morning you could open
like
up
$500 or something to do that, or $5 a share premium.
Yeah,
which would give your net cost. Okay, and then would you sell? Are you like delta neutral, trying to get to delta neutral, or like are you selling?
That position will be managed slightly differently than the rest of the normal products, but you're exactly right. That product specifically is designed to erode, right? It has some drag on it, so we're going to be careful there. But all I really want to say about that is it's managed differently. It is managed a little bit more aggressively. And we have a very small allocation of that as a little bit of disaster insurance.
No, I think that's fine, right? Like, especially if we get like another dump, it's going to be fine. Yep. And even if you sold at the money calls there, you guys will probably still make money. But I think that was my question, is trying to figure out, as you're going through the Q&A part here, like I'm trying to figure out, are they targeting like a delta neutral net position to really just collect the premiums, or okay, so
it's a wheel like the others with maybe a little bit more. We might stray a little bit from it, but we're not. We're really just collecting the premium from it, but it's going to behave opposite, in all probability, opposite the other names in the portfolio. That's if you were to run your own wheel when you're picking the investments, one of the most important things to do is what I call true diversification. I'll give you an example. KWEB, which is the Chinese internet ETF. It has Baidu and JDSU and Alibaba and a bunch of them. It's pretty risky in and of itself, but its beta to the S&P 500 is like 0.35. Oil, XLE and OIH are similar. So when you run a wheel, it's okay to have each one of the investments be a little bit aggressive, but you want them to move independently of one another if all possible. Now, we have a lot of stock ETFs, so they're, general market ups and downs we're going to be affected by. But if we can throw in some things like the VIX and like the oil or energy and like Chinese internet, KWEB, those things are moving differently, and we're still going to collect, somewhere around 20% annualized, but it's not all going to be moving together. So it's very important.
All right, we are coming into the top of the hour here, so going to move into some quick final comments. We'll do another space in a couple of weeks. I think we already have that scheduled. Eric, anything else you wanted to make sure you get into the mix here today?
I don't think so. I appreciate the opportunity and the exposure and the listeners. Rob?
Yeah, same. We really appreciate the time, and just reach out with any questions, comments, and looking forward to being on again.
Sounds good, gentlemen. Thank you so much for coming on and answering our questions. Looking forward to the next one. Jordan, I'll turn it back over to you.
Yeah, this was such an awesome combo. Really appreciate the team coming on. I personally bought a little bit of wheel myself, so I'm holding a little bit and watching it and excited to see how it performs. But love learning about all that. You guys are awesome and just absolutely killing it in this area. And I love that we have this new trading tool to use, and it's something for everyone, right? I think even having Paper Gains on here, someone that's super experienced in this area, right? It's a little something for everyone, whether you're experienced or not. So I think it's super cool, and I'm excited to keep watching it. So thanks, guys. I'm wrapping it up. So everybody should go over to Wolf Space or Amp if you want to open one. Feel free. But I'm out of here for the day. So I love y'all. We'll see everybody bright and early for FAFO Friday in the morning. So see everybody then. Have a great night.
Thank you.